Hello, everybody, and happy Friday. This is John Rhoda at Riverbend Investment Management. This is our big picture weekly market update for the week of September 23rd, 2022. So a couple things obviously have been going on for the last couple of weeks in terms of inflation and some of the lingering data that's been going on that's looking like the Fed's going to get more and more aggressive. This week, they rose the interest rates again by 0.75 percentage point. This was fairly expected, but a lot of people were really just waiting to hear what Fed Chair Powell was going to say about potentially future inflation numbers and how aggressive the Fed would be. And it seems like the Fed is talking about getting more and more aggressive. The idea before was that there was going to be a so-called soft landing, was where they could raise rates to a certain level to combat inflation, and that we wouldn't really have a painful event within the economy. And it seems like that's getting less and less likely. And the fact that the Fed and Powell are starting to state statements like that, it seems like they're sending a signal to the market that, hey, we're going to have to get more aggressive than you guys are expecting. And it seems like that's starting to get priced in the market. And that's really what's been driving the market down for the last couple of weeks. We can see here the S&P 500. I've been talking about this pattern for the last couple of weeks, this triangle pattern. And what happens with these type of patterns is the market will trade between these two levels, and both sides of the market, the bulls and the bears, will really take a position, especially the short-term traders and those trading algorithms. And they're really betting on which way this is going to break out. And the reason they do that is because typically when these break out, there's a fairly significant move in one direction or the other. You can almost think of this as a coil, just gaining more and more energy. And once it breaks through, you get a significant movement. And the reason for that is that you have a lot of people betting on the upside and a lot of people betting on the downside. And everybody who's wrong that has made that upside bet now needs to reverse their position. So they need to sell out of those positions. And that helps drive the market lower and lower. And that's why we're starting to see these more aggressive moves to the downside. Potential targets, a lot of people are talking about this lower level that we hit earlier in the year, of retesting that level and really ultimately looking at this 50% retracement level. These numbers are called Fibonacci numbers. And they've been really getting more and more popular over the years as computer trading has really come to the forefront, because it's hard to program any type of support resistance levels based on a chart like this. So a lot of computer traders like to use these type of numbers as areas of potential support and resistance. So they do tend to hold up fairly well, especially as we start to hit a bottoming process in the market. So I think we're potentially looking at this 50% retracement level, hopefully nothing any further, as that potential target for the market. In terms of momentum, we can see here at the bottom here, this is our momentum indicator. It really shows us how aggressive the current move is and whether it's starting to speed up or slow down. And it seems like this movement downside is starting to speed up a little bit more again. Looking at the bond market, remember, bonds trade inversely with interest rates. So as bond prices go down, interest rates rise. And you can see the market was really starting to linger here in this area of support, retesting that earlier low from earlier in the year. And once that meeting came about this week, really people sold off bonds fairly aggressively. And we can see this bond market just starting to come down more aggressively than even before. Looking at market strength, this is our market strength matrix. I like to say red means stop, green means go, just like a stoplight. And we have a lot of red here, not really a lot of areas for to really look interesting for investing right now, with the exception, of course, of the US dollar, which is starting to get fairly overbought as well. I like to focus at a 200-day moving average is really our trend if we're trending upwards or downwards. And the reason for that is that when we look at historical charts like this, where those 10 worst and 10 best days, you've probably seen charts like this where, especially from the mutual fund companies, where they really like you to kind of buy and hold and stick with it, so they can collect their, so they don't have people really leaving their funds in mass. So they used like to say, oh, you don't want to miss the 10 best days. You have to just deal with the 10 worst days. Well, since the 40s, the 10 best days and the 10 worst days, 19 of those occurred below that 200-day moving average. The only one that didn't was this 1945 way back here. So there's some I like to pay attention to that 200-day moving average because, like I said, you have these more volatile, these more aggressive days below that 200-day moving average that we really want to try to avoid, especially if we're trying to manage risk and volatility within the portfolio. So if we can just eliminate that portion by just avoiding areas that are below that 200-day moving average, we really can like I say, reduce that risk and reduce that volatility level within the portfolio over the long term. So looking at sectors versus cash, one thing I really like to focus on is this idea of cash. And we use these 1 to 3 month T-bill rates as our cash, because this is really what a lot of money markets invest in. And we never want to own anything that has worse momentum than cash. Well, look what has nothing right now in the sectors has better momentum than cash. And the last holdout was energy, and energy has just starting to fall apart again. We're getting stopped out of that today. So the energy sector was really the last holdout with the rising trend, and that seems to be starting to really break down as well. So when we combine these numbers to get our ranking system, we can see that in terms of strength in the market, everything's trading worse than cash right now. So we want to really avoid, like I said, avoid the areas of the market that are trading worse than cash. We can see this within our relative rotation graph. Remember, these kind of rotate throughout time over months and years, and we really want to focus on areas up here. If we're up here, it means we're outperforming cash. We're a stronger sector than cash. Down here, it means we're trading less. We have worse relative strength than cash. And you can see all these sectors are really just in this weak area right now, and we don't have really any strength in the market right now. So it seems like we're having that correlation event where everybody starts to run for the exits within the market. That's important because what we typically see at the bottom of a market cycle is you start to kick in that fear in the market, and everybody runs for the doors. So if you think about your 401k plan, you really just say, okay, I'm panicking with the market, I want out, and everybody starts to sell the market all at once. And you have all these sectors start to become highly correlated together, and that idea of diversification really gets thrown out the window because everybody's selling everything all at once. And you see these high correlation events where everything's very highly correlated as the market starts to panic. And we can see the areas starting to get more, obviously we're not here yet, but we can see the areas starting to get higher and higher levels of correlation as they start to band closer and closer together. And this is a potential early sign that we're starting to possibly start to look at bottoming in the market. Now, this doesn't necessarily mean this is going to happen, that we're going to have some type of high correlation, high panic event. We could have more of a long, just kind of lingering bear market like in the 70s, where we don't really get these correlation events. We just kind of have these up and down rotations within the market over a longer period of time. But we want to keep an eye on this again, just because if we do have this type of event, it's obviously a great buy signal because everybody's selling and everything's on sale. So you really want to take advantage of that. Looking at the CNN Fear Greed Index, like I said, you can see that there is some fear in the market, but it's not that panic level. We're really probably not seeing these type of stories on the 6 o'clock news every day. And when we start to get to those extreme fear levels within the market is when you start to see that really high correlation level, which I said can be a great buying opportunity if you can take advantage of it at that particular point in time. So keeping an eye on the fear levels within the market, and really keeping an eye on these levels within the S&P 500 to see if we test this area and bounce up, or if the market really wants to go down to this 50% retracement level. And at this point, we're going to really take a look at where the strength is in the market, and hopefully start to use some of the cash that's been sitting in the portfolios for the last couple of weeks and months within a lot of our portfolios. So that's really it for this week. Again, if you have any questions, please feel free to reach out to me. Best way and the fastest way is by email, john.rhoda@riverbendinvestments.com. If you're on Twitter, please follow me at John Rhoda. I post more daily type charts and a little bit more detailed technical analysis as well. So hope everybody's having a great start to fall this year. And again, if you have any questions, please feel free to reach out to me. Thanks so much. Bye for now.